Hi, I'm Jackson Summers,
I'm Zachary Cagle.
Katie Marks.
Claire Graves.
and today we are going to go over an analysis and valuation of Microsoft. To start with, Microsoft was founded in 1975, most notably by Bill Gates, and Microsoft's premier focus was on software development, services, devices, and other value-added solutions for their customers. So, a little bit about our project. It's primarily using the valuation of Microsoft's financial information throughout the time period of 2019 through 2023, evaluating starting in 2024. And based on some of the discussed findings that we will soon be getting into, we would recommend a hold position for Microsoft. This is primarily due to our intrinsic value of Microsoft being quite a bit lower than their current per share price. Um, and due to this, we believe that there is not too much short-term gains to be had for Microsoft, and rather it is a more um, long-term outlook for good returns. However, it is an extremely volatile market with a lot of inflated stock prices, especially within the tech field. So that can always come into influence our findings. So first, let's go over our valuation two from project five and go over the stock price derivation from that. So if you look over here, you can see our stock price that we resulted in was $206.66, and our stock price as of 11/21 was $412. So we have about a $206 variance there from our perceived per share value versus Microsoft's current per share price. So, how we estimated this per share value, of course, we use the weighted average cost of capital and a growth rate. Digging into our growth rate a little bit more, it was devised from the current 5-year growth rate trends with a step down to 3.5% as our terminal growth rate. Now, originally, when we had done our valuation two for Project Five, we had a quite a bit higher growth rate of 7%. We instead changed 25 to 28's revenue growth rate to 17% and then dropped it down to 3.5%. Now, if you look at Microsoft's PE ratio, it sits right around 37, indicating they are quite inflated in the current marketplace. And so while our perceived value is quite a bit lower, this does not correctly indicate Microsoft's value to shareholders. So uh, always ever-changing landscape. But to arrive at a value even remotely close to the per share price, we felt like concluding with a 17% year-over-year growth rate until terminal would correctly capture Microsoft's current value. So, digging into our weighted average cost of capital a little bit, we have our beta that was derived from Microsoft returns, as well as the S&P 500 returns. We did a regression by taking market returns and subtracting the risk-free rate that we got from the FAMA French website, and then did a regression on excess returns over the risk-free rate. Next, our cost of debt was derived from taking Microsoft's outstanding bonds and averaging the interest rate on those and dividing by the number of outstanding. Uh, and finally, our cost of equity was found using the 10-year Treasury note, as well as the implied equity risk premium from Aswath Damodaran's website. And you can see that over here, some of our assumptions, 10-year Treasury, weight of debt and weight of equity. There's our cost of debt up there. So next, getting into our sensitivity and scenario analysis. It's extremely important when conducting evaluations such as this to show the implications that if you change certain variables, see how your firm per share value or perceived value is going to change. So beginning with our best case stock price, as you can see that we changed our weighted average cost of capital, we decreased it. We WACC has an inverse relationship with stock value. So decreased WACC, increased value of equity for the firm. So our stock price rose by about $70 per share. And then over here, we increased WACC to get a worst case scenario stock price of $110. So a decrease right there, about $94. We also decreased revenue growth rate for our terminal value, both here and up here. However, we did leave revenues the same for that. And we also have a sensitivity analysis here where you can see more how changing the weighted average cost of capital as well as the long-term growth rate. With our current long-term growth rate, if our WACC were to drop to 7%, as it shows there, our stock price would be more indicative of the current per share market value. So that just shows how sensitive firm valuation is to things like long-term growth rate and weighted average cost of capital. Next, we're just going to touch a little bit on the historical performance insights for Microsoft. So we'll come over here to the income statement where we can see steady year-over-year revenue growth. And the main historical figure that we use in our assumptions was revenue growth for our formulating our growth rate. So as you can see with these high year-over-year growth expectations, they averaged about 17% up until 22 to 23 fiscal year. It was right around 6%. But this consistent year-over-year growth helped us out with our assumption of what we believed Microsoft's intrinsic growth was due to its demand among its customers. So finally, the additional historical figures we used was Microsoft's returns in the marketplace for our beta regression. So evaluating these historical returns helped us find that Microsoft is inherently less risky than the market, and that there is a little bit of a less weighted movement. If the market moves one way, Microsoft will move just a little bit less because of its overall inelastic place within our marketplace. And I suppose one of the last areas that we also have is our cost of debt, because we did use current outstanding bonds that Microsoft has issued. So that is going back and looking at what they've issued since right around 2020. And now I'm going to pass it over to Katie to discuss some industry and peer comparisons.
All right. So if you'll go over to the cross-sectional analysis. All right. The first one that we're going to talk about a lot of them, but looking into Microsoft's financial health against its peers, like we chose Apple, Google, Oracle, and IBM. So we created the cross-sectional analysis in order to do that. So first, we're going to look at like the liability. Here, you'll see that Microsoft exhibits a strong position against its competitors by maintaining a balanced asset structure, high liquidity, and relatively low liabilities. As you can see, it's the 57.46% of its total assets. And compared to Oracle, Apple, and Google, it just positions itself better. Its high proportion of cash and short-term investments, which is the 39.02 of assets, highlights its financial flexibility, which is competitive with Google, but positions itself better against the other. So if going down to the cross-sectional analysis of the income statement, we're going to talk about the revenue and revenue drivers. So Microsoft's revenue composition shows balance and efficiency. And despite not being the largest of the group, it's still showing those. With a gross profit margin of the 68.93%, it does significantly outperform its competitors like Apple and IBM. This indicates effective cost control and strong operational execution on the part of Microsoft. Some of the key revenue drivers include its cloud services and enterprise products, which do differentiate it from its like hardware heavy peers like Apple. So still staying on the income statement cross-sectional analysis for these next few, we're going to go over the profitability and like the high performance margins or the operating income. So Microsoft's operating profit margin is 41.59% of its, and it's one of the highest in this analysis. So what you would conclude from that is it's reflecting its ability to generate significant income relative to its revenue. With this, it positions Microsoft as a leader in profitability, which is surpassing Google and Oracle, and it demonstrates the efficiency of its business model in creating shareholder value. It also achieves a net income margin of 36.45%, which is well above Apple and IBM. With their robust performance, it underscores its ability to convert revenue into profit, and this is done by a diverse product portfolio, cost management, and efficiency in its operation. So Microsoft does invest significantly in innovation, and you'll see that with their R&D expense comprising of the 12.32% of revenue. It is similar to Google, which is at the 12.25%, but it is much higher than Apple at just under 6%. Their commitment to their R&D and innovation ensures that the company does remain competitive in their emerging technologies such as AI, which is huge, the cloud computing and software development. And this is just ensuring they have sustained growth over time, which Jackson did comment on, like the long-term growth for Microsoft. So to conclude just the peer evaluation, overall, Microsoft does emerge as a financially stable organization with strong profit margins, prudent asset allocations, and strategic focus on innovation. Its high R&D spending and superior profitability suggest the long-term growth, which Jackson did indicate based off of our model, and resilience against economic fluctuations, making it an attractive investment option for the long term. So going into the risk consideration, in order, so when evaluating Microsoft's future performance, we did identify 3 areas of risk, which was operational, security, and regulatory. So over on our valuation page, it was a scenario analysis, apologies. This is where we built this into our model. So we identified the operational risks, which include intense market competition, rapid technology advancement, supply chain disruptions, the competitors in cloud computing, AI, software may pressure market share, while reliance on third-party suppliers increase exposure with like logistical issues. Additionally, failing to innovate in a fast evolving tech landscape could impact Microsoft's relevance. There's also a security risk, which stems from the growing sophistication of cyber attacks. So these pose both the qualitative and quantitative threats, such as the service disruptions, data breaches, financial losses, and reputable damages, which could also invite regulatory scrutiny. And then there's the regulatory risk, which remain a significant factor given Microsoft's global operations. There's stricter laws against antitrust and data privacy. Also, compliance could lead to higher costs and reduced flexibility. To account for these risks in our model, we did adapt a conservative growth projection, incorporated higher operational expenses. So we built the scenario analysis, such as the worst case outlook, which reflects increased WACC and slower growth rate to capture potential volatility. In our financial models, we did account for these risks with these worst case scenarios, best case scenarios. And Jackson had gone over those, so I am not going to go back over those. But that is where we did do the risk consideration. All right. So lastly, taking the management discussion analysis and then the earnings call, and we incorporating it into our analysis. Some key takeaways from Microsoft's MD&A and earnings call were how we looked at our analysis. So just our evaluation with Microsoft highlights its strategic focus on the cloud computing and AI. These margin areas are expected to drive long-term growth, which again we have stated with our WACC. I apologize, with our DCF, our Val 2 model. And it's supported by diverse revenue streams like Xbox, LinkedIn, and device sales. And this provides stability across economic cycles. We projected a 17% revenue growth from 2024 to 2028, which is tapering to 3.5 for the long term, reflecting both optimism in the high growth segment and the maturity of certain markets. On the cost side, Microsoft benefits from a stable cost structure, which costs at 59.37% of revenue, enabling the efficient scaling. However, on the short term, spikes in like R&D and CapEx for AI integration may exceeded our model annual CapEx of the 30.8 billion, suggesting that there was room for refinement. So Microsoft's lower WACC of the 8.73% reflects its relatively low risk profile and strong financial positioning. The sensitivity analysis also does reinforce the robustness of our valuation across varying economic conditions, capturing challenges like inflation and currency fluctuations, since they are global. So in conclusion, our evaluation does incorporate Microsoft's focus on cloud and AI, along with its associated risks, while the model effectively integrates the economic and regulatory uncertainties. We could improve assumptions around the CapEx and AI spending for future working capital dynamics. These adjustments would better align our projection with Microsoft's strategic priorities and ongoing investment. That does conclude my area. So I'm going to pass it over to Zach, and he's going to talk about our Excel design.
Hello. For our Excel model, we use the free cash flow, and this evaluates Microsoft Corporation. This model does consider the revenue and expense growth. This model projects the free cash flows of Microsoft by factoring in revenue growth and expense growth. We will rely on the historical data from 2019 to 2023 to project the next 5 years. The first component I want to talk about is the WACC. As we know, it's the weighted average cost of capital. We use the cost of equity, the cost of debt, and the beta. And the beta is going to measure the volatility relative to the market. Another component of this model is the free cash flow equation, which is EBIT 1 minus the tax rate, or EBIT times 1 minus the tax rate plus depreciation and amortization minus CapEx minus changes in net working capital. Another one in our model is going to be the expense projection. The expenses are to calculate as a percentage of the revenue and the expected to grow at the same rate we have projected for the next 5 years. This is going to ensure that our projections are.
Three.
All right, so for the expense projections, the expenses are calculated as a percentage of the revenue and are expected to grow at the same rate we have projected for the next few years. This ensures our projections are consistent with the historical trends. As far as calculating the intrinsic value, we have to calculate the net present value of the free cash flow using the long-term growth rate and the WACC. This involves discounting the projected FCF to their present values. Another thing that we have in this model is the value of equity. The value of equity of the firm is derived by finding the net present value of the free cash flow. We subtract any outstanding debt to arrive at the value of equity, which is at 1.9. The last thing I want to show in this model is the sensitivity analysis and the scenarios. For the sensitivity analysis, you see that we have key variables like the WACC going from 6% all the way to 10%, and the long-term growth rate from 2% all the way to 5%. And Jackson touched on that earlier in the presentation. So moving on to the key findings on the inside of Microsoft Corporation for crucial findings, we have stuff like strong growth rate, diversification, diverse sales. We have free cash flow, high profit margin, valuation, market leadership, and it is a strong competitor in the sector that they are in. For strong growth rate, I like to highlight that Microsoft does have an impressive revenue growth over the past 5 years. Microsoft has achieved a robust revenue growth over 14%. This strong growth rate reflects the company's successful expansion across its various business segments. As far as diversification, they have different streams of revenue coming from AI, gaming, cloud services. So they are a diverse company. As far as free cash flow, Microsoft has consistently generated strong free cash flow. This is consistent, and it looks like it does reinvest in itself with R&D, research and development. So that's always good. And as far as the valuation of it goes, Microsoft it is an attractive valuation, but it has been mentioned that it is currently overvalued based on our model, and the growth rate assumption is a 3.5%. So it can be desirable for some investors, but we definitely want to take a look at it before investing. And as far as being a strong competitor, I would say that it is the top leading company in the sector that it is in, and it can evolve with the changing landscape in the tech field. And so with that being said, I will turn it over to Claire Graves.
So, based on our analysis and valuation, we recommend a strong hold position. If you look at our valued stock price, you can see that Microsoft is currently overvalued. And then also looking at the PE ratio on the ratio analysis tab, you can see that they had the highest PE ratio among its competitors in 2023. The PE ratio looks a little high, but you have to take into account that the tech industry generally does have higher ratios and their stock is generally overvalued. So we took that into account, and that kind of led to a strong hold position. And then based on everything else that my other group members talked about, like revenue growth potential that was really strong, strong financial health, high profit margins, strong liquidity and solvency positions, we decided that Microsoft is a good company, but right now their stock just looks a little overvalued. So you may just want to hold out and wait until you see some new news about plans for growth and projects and things like that before you consider investing. Um, Overall, some of the hardest challenges that we had to overcome in this project really revolved around the tediousness of just making sure like all of our cell references reference the correct cell so the model could be dynamic. And also getting the competitors' financial statements to align with Microsoft. So going line by line and picking through all those and just trying to make sure that everything fell on the same line and row. So that way you could easily compare the companies and the competitors and get like a really good comparison out of that and just make the user experience all the better.